So, you're getting started with the GST system, and it probably feels like you're just drowning in paperwork, right? Well, what if I told you that one of those forms, GST ITC-01, isn't just another task to check off a list? It's actually a key to unlocking tax credits on money you've already spent. Let's dive in and find out how. Okay, so you've just registered for GST. First off, congratulations. Now, before you get bogged down in all the filings and returns, let's talk about something much more exciting, a one-time welcome bonus from the tax system. Seriously, it's designed to give your business a little head start, and it's all claimed through this one simple form. And that form is GST ITC-01. Put simply, it's a declaration that lets you claim back the GST you paid on all your inventory and assets before you were even eligible for input tax credit. Think of it as a starter pack of savings, a pack that honestly way too many new businesses miss out on. All right, let's get into it. Section 1, unlocking your tax credit. First, let's just zoom out and look at the big picture. What does this form actually do for you and your business? You know, the whole point of ITC-01 is to bridge a time gap. See, before you were registered under the normal scheme, you were buying goods and paying GST on them, but you had no way to claim that tax back. This form is the magic wand that lets you go back in time, so to speak, and claim that credit on all the stock you have on hand right now. It literally turns a past expense into a current asset. Okay, moving on. Section 2. Who can claim ITC? This is the big question, right? Let's see if you're actually eligible. You can file ITC-01 in 4 very specific situations. First, if your business turnover finally crossed that threshold and you had to register. Second, you just decided to register voluntarily. Third, and this is a common one, you've switched from the simpler composition scheme over to the normal scheme. And finally, if you sell stuff that used to be exempt from tax but is now taxable. If you're nodding along to any of these, you need to pay close attention. So, let's say you're eligible. Section 3, what's on the table? What kind of stuff can you actually claim this credit on? Let's break it down. You've basically got 2 buckets of goods you can claim for. Over on the left, we have inputs and stock. Think raw materials, half-finished items, and your final inventory. For these, your invoices can be up to a year old. Pretty generous. Now, on the right, we've got capital goods. We're talking machinery, equipment, big business assets. Here, the invoices can be up to 5 years old. But, and this is a big but, you can only claim on capital goods if you're switching schemes or if your exempt goods became taxable. And for these big assets, the credit gets reduced a bit based on how long you've used them. Now, that credit reduction for capital goods, it might sound complicated, but I promise it's just a straightforward formula. Let's walk through how it works. It's a super simple 4-step process. First, just find the total GST you paid on the asset. For our example, let's say it's 1 lakh rupees. Step 2, count the number of financial quarters that have passed since the invoice date. Let's say it's been a year, so that's 4 quarters. Step 3, you reduce the credit by 5% for every single quarter. So 4 quarters times 5% is a 20% reduction. And finally, you just apply that 20% reduction to the original GST amount you paid. And there you have it. From that original 1 lakh rupees of GST you paid a year ago, you can still claim a whopping 80,000 rupees back as input tax credit. That's a huge amount of capital to suddenly unlock for your business. Okay, let's move on to what is arguably the most important part of this whole thing, Section 4, racing against the clock. Because yes, there is a deadline. 30 days. That is it. That's all you get. The moment you become eligible, whether that's the day your GST registration is approved or the day you switch schemes, a 30-day clock starts ticking. You have exactly 30 days to file Form ITC-01. If you miss it, you lose that credit for good. Now, how often you can file really depends on your specific situation. For new or voluntary registrations, this is a one-time only deal, a true welcome bonus. If you're leaving the composition scheme, you can do this once per financial year. And if your exempt supplies become taxable, you can actually file ITC-01 each and every time that happens. All right, we are on the home stretch. Section 5, the final steps and payoff. You're almost there. Let's quickly cover what you need to do to finally get your hands on that credit. Before you hit that submit button, there's one last really important thing you need to check. Is your total claim for input tax credit more than 2 lakh rupees? If the answer is yes, then there's one extra but mandatory step. You'll need to get your claim certified by a chartered or cost accountant. This is basically a check for high-value claims to make sure everything is in order, so be sure to factor in some extra time for this. And that's really it. You file the form on the GST portal, and almost immediately, you'll get an acknowledgement reference number, or an ARN. And soon after that, you'll see that credit amount pop up in your electronic credit ledger. And that's the real payoff. The credit sitting in your electronic credit ledger, which is kind of like a digital wallet just for your GST credits, is ready to go. You can use it to offset future GST payments, which directly cuts your tax bill and improves your business's cash flow right away. So there you have it. The process is clear, the benefits are huge, and you know the deadline is short. Now that you've got all the rules down, what's the very first step you're going to take to unlock this hidden tax credit for your business?